Ivan Feinseth, Chief Investment Officer at Tigris Financial Partners, and Chris Johnson, CEO of Johnson Research Group. Great to see you both. Chris, let's begin with you. First of all, do you think, for the most part, I know there's so many names within consumer staples, but what do you think of the group overall?
Well, you know what? If you look at it, it is a safe harbor group. When you start to see a market that gets volatile and interest rates are going down, people are attracted, or investors are attracted, for two reasons. First of all, higher interest rates. If you look at the XLP, it yields about an average of 2.7%. That's nice if you're looking for a yield. Second, is there lower volatility in higher volatility markets? So historically, the market looks at this group of stocks and says, you know what, I can kind of plant myself here. They're names that people put on their tables, on their cupboards, in their shelves, etc. So they're going to keep going. And that's the primary reason right now that they're starting to become more attractive.
Right, so you're thinking they're more attractive. I can't wait to break down your thoughts a little more, but I have to bring in Ivan Feinseth, Chief Investment Officer at Tigris Financial, saying that he doesn't really like this group so much. Ivan, why not?
Well, it's not that I don't like them. Your other guest is correct. They are a great safe harbor, but I still think we are in a growth environment. And unfortunately, consumer staples have had so much competition and so much pricing pressure because of Amazon and Walmart, as an example of how they pressure their vendors and continue to wring inefficiencies out of the supply chain. They've had a hard time making money, where I prefer, more consumer discretionary items that have had stronger growth. And in even the consumer staple areas, I like a lot of the niche healthcare and food products, which have huge growth opportunities, because we've seen a decline in soda consumption. We see a decline in actual consumption, a lot of traditional products, as consumers pursue a more healthy lifestyle.
Chris, I want to hear your thought. I mean, it sounds like he's being a little more specific on what parts of consumers he likes.
Sure.
I saw you had some names that you liked. Spew some of those out for us so we get a taste of what it is that you're thinking.
You know what, this has become a little more, when you look at especially the ETF world, it's become a little more of a hybrid. Home Depot is in there, Costco's in there. I love Costco because look at their business. They actually work on just generating that one consistent margin. So there are, I have to agree with Ivan, there were some companies out there that may be borderline discretionary that are in the consumer staples sector that are more attractive. But when you look at the other side, the specialty side, the sin companies, or the ones that are typically part of this group that people are attracted to, Philip Morris, Altria, Samuel Adams. These are companies right now that are struggling because exactly what Ivan said. Their business model has been taken apart or picked apart by the Walmarts of the world. Or when you look at the beer area, your Budweiser, your old Budweisers and your Sam Adams, the craft brewers are now taking, which is more of a discretionary, but they're taking their business. So to put it simple, you know what? I like to keep it simple here. Stay away from the Tysons and the Conagras, where their food costs are going up right now. Stick with the Home Depots, stick with the Costcos, the McDonald's, the Clorox of the group, who still have those margins that are going to be steadfast. And I somewhat disagree. I think we're hitting a little bit of a plateau here on earnings growth, and we're going to struggle through the second half of the year. Obviously, next week with earnings, we'll get a taste of that. But I think right now the market is priced fully, and right now these companies that I'm naming are really going to be, they're going to be fine for the second half of the year.
Mm-hmm. You also had Estee Lauder on there, Hershey,
Yep.
McDonald's, General Mills. Any thoughts on some of those?
All are going through over the last year, fundamentally, these are all companies that have gone through a bit of a paradigm shift from a fundamental perspective. They have been forced, for the exact reasons that Ivan mentioned, to change or tweak their business model just a little bit. That's made them more attractive. I think Estee Lauder is one of the standouts in that group. They really were suffering for so long, and management has finally turned this, this large boat in a river around and is doing well. So these are companies that have continued to change their business model or tweak it to kind of take advantage of the situations that the Walmarts and all the big box are leaving behind.
Yeah, Ivan, you mentioned Walmart and Amazon is sort of just taking share away from so many of these companies. Where do you think is a good place to park your money now, if it's not in some of the safe havens of consumer staples?
Well, I like Costco. Costco has a unique shopping experience. The retailers that can differentiate themselves leverage their loyalty program, their shopping experience, and their omni-channel fulfillment capabilities. like Costco and like Target, continue to do well. People pay for the experience to shop, or the right to shop at Costco, and they get value. And also Costco has this treasure hunt-like experience that they continue to rotate inventory, and when you go there, you'll never know what you find. Also, TJ Maxx's stores, or the TJX stores, TJ Maxx, Marshalls, and Home Goods, very similar. They have a treasure hunt experience and a unique shopping experience. So that's, if retailers can differentiate themselves, they still can attract consumers and grow. In the fast food area, my favorite stock is Yum Brands, which is the parent company of KFC, Pizza Hut, and Taco Bell. And they dominate each of those areas. They are the only global pizza brand, the only global Mexican fast food brand, and the only global fried chicken brand. And they are growing in the US and they are growing internationally. They're leveraging their digital initiatives such as order on the app, pay on the app, and their loyalty programs. And those are the keys. Consumers do like and respond well to loyalty programs.
Yeah, Ivan's making me hungry talking about Yum Brands, Pizza Hut, and Taco Bell. Ivan says all that. So Chris, it's funny because you said to stay away from, you mentioned General Mills, Procter & Gamble, Walmart, Colgate-Palmolive, Costco, some of the ones that you liked, and you stayed away from one of the beers, Kroger, Philip Morris, Altria. Why some of the tobacco plays? Some of those are tobacco plays. Why are you staying away from those?
You know what, let's face it, that's a business model that is not only aged, but is one that is extremely hard to turn around. I mentioned turning a boat around in a river. You're turning a barge around in a river with Philip Morris and Altria, and they've been trying somewhat to adapt to the markets, but it's just something that continues to work against them. The last thought, or if there were a last thought I would put in there or interject, is this has turned very quickly to a stock picker's market. It's turned away from one where you're able to index your way through and beat the S&P 500 or whatever your benchmark was. And this, because of the correlations, not only at the market level, but at the sector level, have dropped, which is usually in tune with somewhat of a market top, or when you're hitting into a volatile period. This has turned into a stock picker's market, and that's why I think there's a spectrum to be had when you look not only at the consumer staples, but the retail. You can find your winners, and you will, but they're also laden with a lot of risks right now, Nicole.
All right, Ivan Feinseth, Chief Investment Officer at Tigris Financial Partners, and Chris Johnson, CEO of Johnson Research Group. Great discussion on those safety staples. At least they pay some good dividends.